see how long that takes. But we are going to go into buy land and build using your VA loan, right? And I'm going to share my screen with those of you that are on Zoom. If you're on TikTok and you want to kick over to the Zoom, then you're going to want to click on the link in my bio. TikTok or Zoom, guys, I'm going to say that a few times, so I apologize. You're going to hear that throughout the class tonight because I want to make sure that people know how to find me on Zoom because they can interact a little bit easier. And then they'll be able to see, you guys will be able to see the screen if you're going to be on Zoom tonight. But we're going to talk about buying land and building using your VA loan benefit, right? Okay. So we are one of the biggest teams in the country that specializes in VA loans, buying land and building, and doing that with your VA loan. And let's see here, Mike's in here, so I'm actually going to make him a moderator. He's being promoted to a panelist. That's so exciting. Okay, Mike, you should be promoted to a panelist. Let me know. And then obviously we're live on TikTok as well. So we'll have TikTok questions. Oh, he's a panelist. I think I might have done something wrong, but yeah, you're actually in here, so we'll be able to see you as well. But that's fine. We've got 19 people in. We had 77 that RSVP'd, but we are, for those of you that are on TikTok, we are going to go all into the details about the VA one-time close. Okay, so let's get started. Let me share my screen with those of you that are on Zoom. If you are on TikTok and you want to share, you want to actually see the screen share that I'm doing, you're going to want to kick over, you're going to click the link in my bio and click on the first option. When you get in there, it's the Linktree option, and that is going to give you the option to sign up for the Zoom class, which is tonight, right now. So for those of you that are in Zoom, I'm going to share my screen with you and we can kind of get started. I have a PowerPoint, but I'm opting to not do the PowerPoint tonight because I'm still trying to fine tune it. And to be honest, it's just, you know, another death by PowerPoint. So you guys just get to hear us talk and we're going to go into all the details. Okay, so what does it look like? You have your VA loan, you are VA eligible, and you want to build a home and buy land, okay? So let's start with what does that look like? How do you qualify for buying land and building using your VA loan? So first and foremost, we are going to have you apply for a loan like you would normally apply for a regular VA purchase, okay? On your end, when you're filling out the loan application, there's not a massive difference between how you're completing the loan application for the custom construction. This is called the one-time close custom construction loan. That's the program name. And not all lenders offer this program. As a matter of fact, most lenders don't offer this program. And if they do, if they're a mortgage broker, be very cautious of utilizing them for a VA one-time close because they are working with two wholesale lenders. There's only two wholesale lenders that we know of that offer the VA one-time close custom construction right now. And they're both a nightmare as far as their process goes. So it's not even really the broker's fault. It's the company that's handling the VA one-time close construction loan and their process. Their process is not fun. It is not enjoyable. It's not efficient. And you are going to struggle if you go down that road. And you're also going to pay more money for it. So that's, we actually helped one of the wholesale lenders help create their VA one-time close construction program, and they didn't execute it exactly as we said they needed to execute it. So at this point, you're going to be better off going with our company. And I'm not just saying endorsing us because it's us. I'm saying our company actually is the #1 VA jumbo one-time close lender in the country right now. So jumbo means anything over the conforming loan limit. As you guys can see on my screen, we have the conforming loan limit in most counties is $766,550. So we are doing quite a few of these VA one-time close custom construction loans nationally across the country. And so we're becoming very well versed in them. We've done a lot of them. We've been closing them for years now. And we have our own construction department internally. So we're not shipping this out to a third-party company, which makes a huge difference. Multiple reasons why. First of all, we're doing our own underwriting, our own approval of the builder, our own approval of your construction project. Everything is done internally. And that makes a big difference when it comes to construction loans. Construction loans are very cumbersome. That's why most mortgage companies don't offer the VA one-time close. So if you've ever been told, no, there's no such thing, That's because that mortgage company doesn't know that there is a VA one-time close. And we hear that all the time from our military community. They're constantly hearing that they're being told that there isn't a custom construction loan or construction financing with the VA loan. And that's just not true. So the VA custom construction loan is going to help you finance the purchase of the land and the build of the home, all the way through to the finishing completion of the build of the home. And when you go to purchase the land, the first thing that you're going to want to do, regardless of what you're doing, is to get your pre-approval knocked out, because the lender really can't determine what your ceiling limit is, and you can't figure out what your budget is for building, how much you can spend on land, how much you can spend on construction. And then there's a whole bunch of incidentals that are not necessarily fees, but they're just cost to construct a home. And I'm going to go over those with you guys so you can see what those are. But it's important to know the pre-approval process is not any more cumbersome. For this particular program, you do have to have a 620 credit score. For our regular VA loans, you do not have to have a 620 credit score. If you're buying a house that's already completed, or a builder is building and financing the home for you, then you're going to go with what's called just a regular VA loan, right? Now that's the difference of a regular new home in a new neighborhood, or a new home that a builder is building for you, and this program, the VA one-time close custom construction loan. The biggest difference is who's financing the construction. If the builder's financing the construction, then that is not considered a custom construction loan. If the builder's financing the construction, then you're just going to use your regular VA loan for that purchase. If you're financing construction, if you're finding the builder, you're finding the land, you're figuring out what floor plan you want to build, and you're using custom construction financing, that is this program that we're going to talk about tonight. Okay. So that's important, because there can be some confusion and overlapping with whether it's new construction or a custom construction loan. So the custom construction loans are going to have more restrictions and more overlays. VA does not have a minimum credit score requirement. So for our regular VA loans, you don't have to have a minimum credit score. But for this program, there is a minimum credit score of 620. And the reason for that is because there's a higher risk involved with this loan program. The lender, whoever it is not able to guarantee the loan with the VA until the house is 100% completed. And we are closing on the loan, and we are giving you the money to start building construction and to finish construction. We're giving you all the money, you and the builder, prior to having that guarantee from the VA. So if you decide that you're not going to make payments, or the construction never gets finished and you're not able to make payments on it, then the lender's at higher risk. So that's why there's some of these additional restrictions to this particular loan program. We currently offer this loan program in 49 states. So the VA one-time close custom construction is available in 49 states. Alaska is the only state that we do not currently offer this program in. Okay. So the FICO score is 620 if you're going to go up to 766, 550. When we talk about the FICO score, that's the credit score. We are pulling a tri-merge, so Equifax, TransUnion, and Experian. This is very typical for mortgage credit reporting. And we are going to take the lower middle score. So if there's two borrowers, we're going to throw out the high score for both borrowers, throw out the low score for both borrowers. Then we're left with two middle scores, and we're going to take the lower of the two. This is typical for mortgage companies. This is how mortgage companies always calculate the qualifying credit score. Okay. So we have to have an automated loan approval. And this is VA's requirement. This is not our overlay. VA requires that these VA one-time close custom construction loans have an automated loan approval. So we need to make sure that we get whatever file, whatever loan we're working on. There's some things that you can do if it's not getting an automated loan approval. There are some things that you can do to obtain an automated loan approval, give yourself or give you a better chance of receiving that automated loan approval. And sometimes we just can't get it. And if we can't, then we have to restructure and figure out a different solution for you. So again, has to have automated loan approval. There is a max loan to value. So it's $0 down up to $1 million. Over $1.001 million, it's a 5% down program. If you go over $1 million, you have to have a 660 score. If you're between 766, 650, and 1 million, you have to have a 640 credit score. Okay. So that's kind of the credit, income, debt to income ratio requirements. Now, actually, I didn't talk about debt to income. Let's talk about that a little bit. We can get some exceptions to debt to income ratios, but generally speaking, they want to see it at a 55% maximum debt to income ratio. And we're talking about your permanent loan here. So when we're qualifying you for these VA one-time close custom construction loans, we're actually qualifying you for the loan once the house is completed and everything is rolled into the loan, okay? So I'm going to go into detail about what is rolled into the loan, but that's how we're qualifying you. So if you have a piece of land that you're interested in and it's $200,000 and it's going to cost you $60,000 to excavate, clear the lot, clear the trees, excavate, bring a dirt road to the lot, bring in utilities. Maybe you're drilling a well and installing a septic. All of those things can be rolled into the custom construction loan, okay? And you're going to probably want to roll those things in unless you have a bunch of cash sitting around and you're just trying to finance the least amount of money possible, which is fine. We do have some buyers that are like that. And if that is you and that's your particular situation, then you can pay for some of those things up front. They will be considered in your lot equity, potentially, depending on how the appraiser marks that information. But again, you can finance the development and the improvement of the lot in the VA one-time close custom construction, okay? So that can all be rolled in. So kind of moving, we do have a maximum per guidelines, but we have gone over the maximum of $2 million. So we have done financing for over $2 million on the VA one-time close custom construction loan. Again, it would be 5% down. So, and I have a client that's a physician that actually is a past client of mine, and she didn't even know this program existed, the VA one-time close. She didn't know it went into that jumbo category because we used to have the county loan limits that we had to adhere to prior to the Blue Water Navy bill, which was released in 2019 and went into effect January of 2020. When that Blue Water Navy bill came into effect, the new rule for using your VA loan is if you don't currently have a VA loan outstanding at the time that you close on this construction loan, then you don't have a cap on your VA entitlement. You just have to credit and income qualify for whatever it is that you're financing. So you could go to, 200 or 2 million, 2.5 million, zero down with a regular VA loan. And then obviously with this program, it would be a 5% down payment. So, but just to kind of clarify on that, if we go over loan amounts of $1 million, $1, there's some compensating factors that we have to have, and it's nothing out of the normal. It's nothing difficult to accomplish, but it is one of the requirements. If your property taxes are exempt because you have a disability rating, and your local county, local taxing authority recognizes your disability rating and is giving you an exemption, then we actually can qualify off of that exemption. It must be applied for and approved by the municipality prior to our loan closing. So we would be able to provide that documentation. Texas is a state that you can get that done in. Florida is a state that you can get that done in. So in some states you can apply for that or get proof from the municipality that you're not going to have taxes. If you're 100% exempt from your taxes, then we can qualify you that. And then we're going to talk about soft costs. I'm going to show you I have a cost estimator. I'm going to go through kind of how the costs are calculated on this loan program. So I will show that to you so you can see what that looks like and how they're calculated and what you need to be thinking of when you're looking at planning your own custom construction project. The loan term for these is going to be either a 15-year or a 30-year term. Okay, that's the only options, 15 or 30-year. What that typically equates to for your actual 30-year fixed or 15-year fixed term, it actually equates to usually 14 years and some change or 29 years and some change respectively. And that depends on how long it takes you to build your house. So we do have a 6, a 9, and a 12-month option. So depending on how long it takes your builder to build your house, how this works is you get a construction loan that is an interim interest only construction loan. That is the loan that is financing the construction during the build. Now, one of the greatest benefits of the VA one-time close custom construction loan is you are not allowed to make interest-only payments during construction. So you don't have to, which you do in most other cases with any other construction loan program, you do typically have to make payments on the draw balance that has been drawn during construction. So if your first draw pays off your land and releases the draw to the builder to start framing, immediately when you're in a construction loan, a regular conventional construction loan, you're starting to pay interest-only payments immediately upon funding of that construction loan. In this particular case with the VA, you are not allowed to make payments during construction. So it's most veterans and service members appreciate that because most people don't want to have two housing payments when you're living in a house and or apartment, or you have some sort of housing expense while you're building. They don't want to have to pay for the place that they're living in and the new home that they're building. So that's one of the greatest benefits of the VA one-time close. Now, the interest gets rolled into a soft cost that gets financed into the loan amount. Okay, so it basically gets rolled into the loan amount, gets, the builder ends up charging a soft cost fee, and the interest only payments and construction management fee are rolled into that soft cost. So we're going to show you again, I'll show you some calculations of what would a soft cost be at some estimated build price. Okay. So you can visualize that because I'm a visual person and I have to be able to see with my eyes so that things click and make sense. So again, the construction term cannot exceed 12 months. 6 to 9 to 12 months are the term options. And that will factor in a little bit to your interest rate. It will factor into, obviously, the interim construction interest that is charged, because if you're building and it takes you 6 months, you're going to pay less interest than if it takes you 12 months during construction. So, but that's the construction rate is what you're going to pay during construction. And again, you're not paying it. It's accruing into the interim interest that's rolled into that builder fee. Hopefully that makes sense. Now, if you start with a 30-year term and it takes you 12 months to build, then once we have your certificate of occupancy and 100% of the house is completed, we will modify the note, modify your mortgage, and that's when you roll into that 29-year fixed rate VA loan that we lock in prior to closing on your construction loan. So we are going to lock you in on your fixed 30-year fixed or 15-year fixed rate prior to closing on the construction loan, which is prior to starting construction. But we have another really cool feature with this program, which is the automatic one-time float down. So if rates have dropped, if they have gone down, lowered since we closed on your construction loan and we started construction and construction was completed, at the time that we are modifying your note, we will do a float down of your interest rate one time for free. Okay, which is incredible because construction terms can take a long time. And we don't want you to have to turn around and refinance it. It's not good for you. It's not good for us. So the benefit of doing the one-time float down is we retain your business, we retain your loan, you don't go refinance it, and you're happier because now you are with a lower, now your long-term rate is a lower rate than what we initially estimated it's going to be. Okay. So when you're locking in your interest rate prior to closing on these construction loans, you can pay points to buy down the rate. And those points will equate, they will convert to your permanent float down rate. So you'll be able to apply those at the time that you're floating down. You'll be able to apply those to getting a better rate at that time. Okay. And you guys, I know there's a chat, there's a Q&A section, so you guys can ask questions in there. I'm going to go through and address some of the questions that I am seeing on the Zoom, and Mike is addressing the questions on the TikTok. So, yeah, James Hopkinson, I think we answered, or Hopkinson, I think we answered your question to define what makes a one-time close loan different than a normal loan. The normal loan is you're not financing construction. So either the house is already existing or a builder is financing construction. On the VA one-time close, you are financing construction because most builders don't want to finance construction on a custom-built home. Most builders don't like that risk. It's a higher risk. They're building something to your specifications, not their specifications. If I'm a builder and I'm building homes in a neighborhood, or I own some land and I'm going to build a home on land, I'm going to want to make sure that the color palette is going to be something that if my buyer can't qualify for financing or if my buyer backs out, I can put it on the market and resell it, no problem. I kid you not, I used to sell homes with builders and I used to be a community sales manager for a real estate company. And we would have people paint the interior walls like pink and crazy colors, not just for the kids' rooms, like the entire house. And so that's one of the reasons why builders, people will do some unique things that are unique to them when it comes to custom construction. So that's why builders are like, we're going to, we'll let you finance the custom construction. If you want us to build you a custom built house, we will absolutely do it. But if we're going to build your house, we're going to, we're going to pay for the financing and pay for the construction. We're going to build it to our specifications. And that's typically what most builders say. So that's the difference between the VA one-time close custom construction and regular financing. Brian's asking, can I be my own builder? Unfortunately, with the VA loan, VA does not allow an owner builder. So you have to have a GC of record. You have to have a general contractor of record. So if you happen to be in the industry and you can work for a general contractor for the project, but you have to have a GC of record. That GC of record can be a family member. So if you have a family filled with builders, a lot of people have that. It's just, people tend to stick together and stick in the same trade. But if you have a family member who's a builder, they can be your GC of record as well. And you can get an extension on the build time. If you guys look at the screen here, a 30-day extension does not have any cost. It's available if one of the following applies. The builder has formally requested the final draw, the final inspection has been ordered, or the certificate of occupancy or the equivalent has been issued. So that's where you get a no-cost 30-day extension. If you need a 60-day extension, it's half of a point. So half of a point of the loan amount, total acquisition and total loan amount. 90 days, it's 0.75 of the loan amount, which, to be honest, you guys, is really affordable. I've worked with some mortgage companies that did custom construction financing, and their extension fees were much more expensive than that. So it's actually really affordable. Minimum loan amount of $100,000. So we have to finance a minimum of $100,000. And Raul, we will be talking a little bit about the multifamily options and what kind of properties you can build with the VA one-time close custom construction. Joshua, you said yes. And I missed. Oh, okay. I think you're answering, Raul. So that's great. Thank you for answering, Raul. Brian, you already have a foundation done. Anytime you already have a foundation done, that kicks more to a renovation loan than it does a custom construction loan. We can take a look at it. We could take a look at it for a one-off. If it's just strictly the foundation that's been done and you have plans and the foundation's been done fairly recently, and the foundation was permitted and other things, like we can take a look at that and see if we can get an exception from our construction department. But usually when the construction has already commenced, usually it kicks over to a renovation loan. And there is a VA renovation loan, but you would not be able to finish construction with the VA renovation loan because the VA renovation loan is more of a, it's going to be a less funding, less money available. It's more restricted. It's not going to give you as much money as you need to finish construction of a home from ground up. So, or from foundation up. But there are some conventional rehab loans and some FHA rehab loans. So James, if for some reason, Brian, if for some reason, we can't finance that with a VA one-time close custom construction, we could look at a renovation loan to help you finish the construction. Do you normally close multiple times on a normal construction loan? I know the difference between construction and normal loan is that it was the one-time close. And this truly is a one-time close. So one of the greatest benefits of a one-time close is it's not a two-time close construction to perm, where you have to do construction loans separately. So you pay one set of closing costs on the construction loan and then a second set of closing costs on your refinance. Because technically on a two-time close, you're actually refinancing the construction loan into your permanent loan. The other downside to a two-time close is you have to qualify twice. So if something happens between the time that you get your construction loan and you finish construction and you're going to buy that or you're going to refinance and you no longer qualify, you are SOL. Like you're scrambling to try and figure out options. So if something pops on your credit, if you have something happen to your income, you lose your job, that could cause a big problem for you where you don't actually get to close on the refinance. And you're stuck in that construction loan, and then your construction loans are interest only, they're higher interest rates. Like that's not a situation you want to be in. So that's another really huge benefit to the one-time close. You qualify prior to closing, prior to construction starting, and you qualify one time. You get one appraisal. That's another benefit to the one-time close. You only have to have one appraisal. So if the market happens to decline a little bit from the time that you get your initial appraisal to the time that your house is 100% completed, you don't have to worry about having to come to closing with cash out of your pocket because your construction or your appraisal didn't come in, your second appraisal didn't come in as high as your first appraisal. So those are all really good reasons why the one-time close is so much more beneficial. You save money. It's guaranteed, to get into that next loan, that permanent loan, and you don't have to have an appraisal. You don't have to worry about value after the initial appraisal and the initial structure. Hopefully that answered your question. Paul White, even if you are a GC, you still have to have a GC of record, okay? All right, guys, I'm going to keep going, but I'll get back to more questions. We'll make sure we get all your questions answered before the end of the night. Temporary buy-downs are not permitted on a construction loan. You can do a permanent buy-down where you're paying points to buy down the interest rate. And again, that will translate over to your permanent loan at the time of float down once the house is 100% completed. It's a fixed rate loan only, so we do not have ARMs, no adjustable rate mortgages for the VA one-time close. And there is a minimum gross living area of the property at 750 square feet. Okay, so we get a lot of people that ask, can you do a tiny home? Depends on how you define a tiny home. Tiny homes are often on wheels, and they're not affixed to a permanent foundation. The house has to be affixed to a permanent foundation, and it has to be at least a minimum of 750 square feet. No manual underwriting. We have to run it through our automated underwriting again. That's a VA requirement. There's no down payment assistance programs and no mortgage credit certificate programs allowed in combination with the VA one-time close custom construction. Let's see here. Site build. Okay, so what types of property can you finance using the VA one-time close custom construction? So we can finance a single family detached residence stick-built home, right? Regular construction, conventional construction, I would say. You can finance a modular or a hybrid modular home. You can finance an ADU, but only if it's accompanied by the construction of a single family home. An ADU is an accessory dwelling unit. So you could have your main house, and then you could have your ADU, which could be like in the Arizona area, they call it a casita. I know they call it, I think they call it a carriage house in other markets, and there's all different kinds of terms for it. But an ADU is smaller than your primary residence, so it has to be smaller, and that will exclude manufactured home transactions. So if you're doing a manufactured home, you can't have an ADU and a manufactured home on the construction program. It has to be stick built. Okay, so site built, but yes, you can do a small mother-in-law ADU and a main residence, and we have to be able to appraise it properly, right? So the appraiser has to be able to comp it out, find comparable sales. You could do a manufactured home. Manufactured homes are allowed. They have to be newly purchased and never attached to a foundation before. It has to be a multi-wide, no single wide available. You can't meet the minimum square footage requirements on a single wide manufactured home. And only a primary residence, which on VA loans, these are only primary residences anyways, because you're required to owner occupy with your primary residence, right? And then, like I said before, ADUs are not eligible in conjunction with manufactured homes. You can also, now don't pay attention too heavily to this 2 to 4 unit section. Our team has been approved already by the construction team to do a multifamily VA one-time close custom construction. I'm going to talk about that in a couple of minutes. Barn dominiums are allowed with the VA one-time close custom construction. So barn dominiums are going to be, some of the requirements for barn dominiums are that the garage shop area cannot be larger than the square footage of the home. So the square footage of the home has to be bigger than the shop area. And you can't be using it for commercial purposes. Like you can't have a business out of there. Now, if you have a hobby and you're, hosting your hobby out of your shop, that's not a big deal. But we're talking about like the business that you qualify for, income wise, you run a auto body shop and you're going to move that into the home. We are not going to want to present that, and we're not going to want to have the file structured that way. You're going to need to just have it be a hobby shop because VA has restrictions on that type of thing. So, but yes, you can finance a barn dominium. Again, just adhere to those couple of requirements, but nothing major, nothing super difficult to meet the requirements on. And there's some beautiful barn dominiums out there. A lot of people are going with the barn dominium construction style. So you can also have a shop, a detached shop that you're financing in the package with your custom construction build. And then you can do a 2 to 4 unit. Okay. So if you're doing a 2 to 4 unit, we currently do not have the ability to use the income from the additional units to help you qualify only with the VA one-time close construction program. If you find something that is an existing 2 to 4 unit property, then we can use the income from 75% of the income from each rental unit, each additional unit, we can use that to help qualify, but not on the VA one-time close custom construction loan, okay? But you can absolutely finance a 2 to 4 unit. You just have to qualify for the entire purchase price and acquisition cost yourself, okay? No condominiums, no agricultural properties with working farms or ranches, working ranches. But you can do like homesteading. A homestead is not an issue. And there's no maximum acreage requirement. So you can get 100 acres if you want to get 100 acres and build on it. 10 acres, 50, like whatever it is, there's no maximum amount of acreage. And that's going to be unique because a lot of lenders will overlay that and have maximum acreage on just regular VA loans, let alone the custom construction program. No mixed use. Mixed use is potentially like multifamily and commercial. Residential commercial use is what mixed use would be considered. So no mixed use properties either. And that's why they say on barndominiums, you can't operate a business out of the garage. Any property already under construction with structural work completed. Okay, so we talked about this one earlier, the foundation. I think it was Brian who asked me that question. So it is in the guidelines that we can't do that. But I do think that I maybe had an exception potentially at one point. We didn't close on it, but I think there was agreement that we could potentially do something there. So if you're really interested and you have a foundation, Brian, and you want to reach out to us and we'll find the solutions that are available for you. Okay. All right, I'm going to stop real quickly and answer some more questions because I know there's a lot of unique questions on this program. Yes, you can build up to 4 units. Are ADUs allowed? Yes, we talked about that. I could build a main house and a building for a business. Andrew, you just can't have it be your business, you know, while you're building it and in the immediate future, because the VA program is not built for a business. But if you have like a hobby slash, you know, like leatherworking business or a woodworking business or something like that, but you're not actually having clients come to your place of work and it's just where you're just working from home. It's like a home office. Home offices are allowed. That's not a problem. Okay, how much smaller does the AU have to be compared to the main house? Kareem, that is a good question. We haven't defined that for an ADU, but it has to be smaller. I can tell you that much. We can clarify. I'm going to write down questions here that we can get back to you guys with. So ADU square footage difference. Okay. So we will get back to you with that info. ADU square footage difference. Okay. Good question. Thank you for asking. Let's see. What other questions do we have? Cassie O'Driscoll. Do you mean you can do them at the same time? I think you're talking about ADUs. Yes, you can do them at the same time. So the builder can be having all the construction for the ADU and the main home together in your planned package. Your planned, what we call it, your total acquisition cost, which is the cost of land, cost of the construction, cost of any improvements, and anything else that you're rolling into the loan. Total acquisition cost. Viola or Viola, whichever, I'm sorry if I pronounced that wrong. We talked about barndominiums and an ADU. Yes, you could do that. Manufactured homes. Does manufactured include barndominium? There are 2 different types of construction. So they would not, no, you would not be able to have a barndominium and a manufactured home on the lot together. Anytime you roll a manufactured home into that multiple units on one piece of property, it's not allowed VA. Now, on a completed project, you could do it. If it was already constructed or you were buying something where the manufactured home was already on there, you could do that. A lot of times people will find a lot that has a manufactured home on it, and you would need to decommission the manufactured home if you're going to build a house on that lot. So that would need to be part of the demolition, and the demolition would need to be part of either your pre-work to the property prior to construction, prior to closing on it, or part of the bid that the general contractor has put the cost to demo the property in the total cost to build, and you're financing that, okay? So do I have to own the land beforehand, or can I buy and build the same loan? David Scott, you can buy and build in the same loan, or you can own the land, or you can owe money on the land and own the land. Sometimes when I say own the land, people think that you have to have it paid off and owe nothing on it. That's not what I mean. When I say own the land, I mean you're entitled to the property as the owner, and you could still have a loan on it. We can pay off the loan with the first initial draw, and then now it's all combined into one property. If you own the land outright, you do have to secure the loan off of the land and the home. I had a client that I was talking to one time where they had been told wrong information from another lender, and they had thought, because they had a home that they owned, it burnt down in a fire, so complete burn down. So they demolished the home, and the insurance company did and everything and paid them. And so they own the land outright. The mortgage is paid off with the insurance policy. And they thought that if they used the VA one-time closed custom construction loan to build the home, that it would not be secured on the land, it would only be secured on the home, and that they would still own the land outright. And that's not, in order for a residential loan to be secured on the land, you have to put it all on one deed, okay? So there has to be a mortgage against the entire deed and the entire legal description, which includes the land underneath the home. So just to clarify that, if anybody has that question. Log homes are allowed as well. Yes, we can do log homes. Let's see, Mike is answering questions. Right now, container homes are not allowed, but you can do 3D printed homes. So I do think that we will see container homes open up in the not too near future, because there's some really nice container homes. A lot of it is about local building authority as well, and what the VA says, is typically following local building authority. Okay, Andrew, so dog training, but it says it's for my personal dog, but I say it's for my personal dogs. I mean, you could do dog training on site. I think if you had a dog boarding business and you had built out a entire barn with a ton of kennels, they might wonder, like, do you just have a lot of dogs and you really enjoy hunting, or what is it? So again, it's going to be what the appraiser is seeing when the appraiser is completing the appraisal on the plans. And then there will be an inspector that goes out to release draws to the builder. So the inspector goes out to make sure that all the work that the builder was supposed to do with the most recent draw has been completed before they release more money. Because what we have seen in this industry is sometimes builders will borrow from Peter to pay Paul. So they will take money out from one project to finish another project, and that ends up getting them into financial trouble. So that's why we send an inspector out to sign off on the draws and to make sure that all the work was done that was supposed to be. The funds were allocated to do all this work with this, this draw number 3 or draw number 2. So the inspector is going to look at that and make sure the work was done. But yeah, I don't see that training dogs is really a big deal. Nina Torres, we have a lot of land for sale for like $50,000. I just want to understand, how would I know how much everything costs? Nina, that's a good question. And I'm going to get into that question because that is probably that's a lot of the challenge, trying to figure out, you can get pre-approved fairly easily and you can find land fairly easily. The big challenge is, how do you find a builder that can build you what you want to build for the cost that you want to build and get you in your budget? Because that's the challenging part. So we're going to talk about that a little bit as we get a little further into the class here. So log homes are included on the construction loan. Yes. Can furniture, fixtures, appliances be purchased within the loan parameters? Fixtures and appliances, yes. Furniture, no. Typically not furniture. Jonathan. So Raul's asking, will the VA home loan build a home in an aircraft hangar in an airport neighborhood? Ooh, good question, Raul. Mike, have we been asked that question before? I don't know if we have. Yeah, we do finance in New York. Yep, we can do the buy land and build in New York. Raul, I'm going to get back to your question. I think you asked me the last question that you stumped me on. So I think you're just asking the stumpers tonight. Aircraft aircraft hangar. Can you build an aircraft carrier on your lot? That would be amazing. Okay, so aircraft hangar, we're gonna double check that. That's a really good question. Usually those are steel structures, or aluminum structures, right? Aren't those usually like post barns kind of, which usually are not covered by the construction program. So I'm going to estimate the answer is going to be no, but talk to me a little bit about the type of construction materials being used for the aircraft, or for the, aircraft hangar, airplane hangar. Okay, let's see. Does all the multifamily have to be built the same? No, Chastity. You can have different kinds. You could have like a 3-2, 2-2, a 2-2, and a 3-2, or a bigger unit and smaller units. That's going to be up to the appraiser, how they appraise the property. But you don't have to, they don't have to all be identical units. Okay, I'm going to let Mike kind of handle those questions and keep moving. So construction contract type. So this is really important because you do have to have a contract with the contractor. So as soon as you find your GC, your general contractor, we have to first get them approved. So this is important to know that there is a process to get the builder approved. Now, our builder approval process is not super difficult for the builder, but they need to have experience building homes recently, okay? They need to have a history of building homes. It doesn't have to be a ton of homes. I think it's 3 for the last 2 years. They have to have built 3 homes and 5 homes or something like that for the last 2 years. I'm gonna show you the checklist, and it will have that information on there. So general contractor and builder has to get approved. And obviously borrower cannot act as their own GC or builder. There's no do-it-yourself or self-help. The VA doesn't allow it. Third-party management company agreements are not allowed. Honestly, you guys don't want a third-party management company agreement. It just sucks up revenue or sucks up money from the project. And your builder and GC of record should be able to manage the project and the funds. If they're the right builder and the right GC of record, they will be able to manage the project and the funds. So we don't allow you to pay a third-party company. All work, including labor and materials, are required to obtain a valid certificate of occupancy must be included in the builder, contract, and cost of construction. Borrower cannot exclude items that may be paid out of pocket, including site prep items. Now, if you get to the lot and you do the site prep ahead of time, then that is done, right? So it's not a part of our project. It's already completed. And we have had some buyers or borrowers that are working for the builder and doing some of that work. So I think we can talk a little bit more about flexibility there. Cost plus contracts are ineligible. Only fixed cost or fixed price contracts are eligible. So let's talk about the difference. Cost plus means I'm a builder. You're going to hire me to build this home. You have picked a floor plan, and we have sat down and we have figured out all the specifications of what's going into the home. And then I'm going to give you a cost plus contract, which means whatever the cost to construct is, I'm going to tack on my profit of 10 or 15% on top of that. And the contract is going to read, this is a cost plus contract. I'm charging you the exact invoice from the plumbers to the framers to the materials, windows, sheetrock, siding, like everything, painting, interior finish, interior carpenters, like all of that stuff on a cost plus contract. It's the actual cost that gets billed from a subcontractor plus materials. So materials and labor plus a percentage of profit that the builder's charging. The reason we don't like that is because this is where cost overruns go out of control. Because if you don't have a general contractor holding their subcontractors to the initial agreements of fixed costs, then you end up having cost overruns on your budget. So the fixed cost is the way that we protect. It's one of the ways that VA requires that we protect our, the veteran community in their building projects, to make sure that the fixed cost overruns aren't typically going to hit the buyers as much. There's much less fixed cost overrun. So fixed price means that the general contractor is basically saying he's going and getting his bids, he or she going and getting their bids from their subcontractors. They're pricing out materials, and then they're saying, I can build you this home for $700,000. And they're factoring in their profit into that $700,000. So if cost goes up or they go down, and they've already given you a price, a secured price item for that, or like an actual cost for that item, then they have to abide and follow through with what they're charging you on that item. So the risk is more on the builder to make sure that they're doing their bids and quotes and putting the pricing together properly on the construction project. I had clients that was actually a real estate agent of mine years ago that did a cost plus contract, and they ended up going over $150,000 over budget. Now, sometimes that can be the fault of the people building because they go over budget on tile and the lighting package and the flooring package and everything, because they just have a more expensive taste as they're going to make their selections. But most fixed cost builders will tell you, okay, here's your lighting budget. Now you can go to the lighting store and pick out your lights, but you have to stay within this budget. And if you go over this budget, then you pay the cost out of your pocket separate from the loan. Same with tile. You go to select your tile and all of your selections for your hard surfaces, you know, granite countertops or Corian or quartz or whatever it is that you're going to select. I said Corian. I don't even know if anybody uses Corian anymore. But the fixed price will have you having to come in with the overage if you receive a fixed price quote and you're receiving a budget, which rolls into the next conversation, which is a contingency reserve. So we do require, and all lenders are going to require, contingency reserve on a custom construction loan. A contingency reserve is where we put aside 2% of the cost to construct, and it goes into an escrow account, and it's there in the event that you go over budget on materials or anything that's related to the home. So if you go over budget, there's a 2% of the purchase or the total cost to construct set aside in an account, and you can dip into that money to use it because it's already qualified in it's already factored into your financed amount. If you do not use that 2% and the builder did a really good job and you did a really good job staying within your budget, then that 2% gets applied as a principal reduction to the loan amount when the modification happens. So you actually get that money back. It goes to the principal reduction, so you end up financing that much less of the total cost to build. Okay, so that's really cool. It's a good thing, even though it's going to inflate the amount that you finance initially. If you don't use the money, then it just goes right back down when your permanent loan is fully modified. Building permits, all loans where the subject property is located in Florida and lot is owned by the borrower prior to closing will require confirmation of approved building permits prior to the CTC being issued. Does not need to be paid for or picked up. It just has to be an approved building permit. And the reason for that is there's markets in Florida where the building permits are taking a really long time. So that's one of the stipulations in Florida. Now this says ineligible Hawaii and Alaska and PR Puerto Rico. Puerto Rico is ineligible. It's not one of the 50 states. We do offer the VA loan in Puerto Rico, but not the VA one-time closed custom construction loan. Hawaii, we are offering our team, Veterans Lending Group. We have a special deal with the construction department at Cross Country Mortgage, which is our parent company, and we are able to offer financing, VA one-time closed financing in Hawaii. So that kind of goes through like the stipulations of the requirements. Now let's talk about the builder approval process. So I'm going to go to that form. Bear with me here. I just got to be able to navigate there. And I've got this website chat here. And let's see. How do I navigate back to? Well, I only know how to get there from the main page. So I'm going to go back to the main page and get there. Okay, so the builder, let's talk about getting a builder approved. So the builder has to have two things. The builder has to have a registration number by the VA, which is super simple, very easy. All they have to do is apply. There's like 5 forms that they have to fill out, submit to the VA. We can help them with this. So if they don't know how to do this, we can help them. We're happy to help them. And what we do is we complete that, submit it to the VA. VA takes 3 to 5 business days, and then they issue an approval for the builder, a builder ID number. It's really not an approval, it's more of a registration, and then they're good to go. Then we have our internal requirement, which is where we are going to require the builder to fill out this builder acceptance package so that we can make sure that your builder that you have found, and we're able to help you if you need help finding a builder, but your builder that you have found is going to be a good builder to work with. So the way that we do that is we go through this builder acceptance approval process. So the builder is required to fill out this package. They have to complete and sign the builder profile. They have to provide a copy of their state builder contractor license. They have to provide a certificate of general liability insurance with an aggregate of $1 million minimum coverage. They have to have a list of authorized signers for the company. Completed statement of workman's comp coverage disclosure, evidence of workman's or workers' compensation insurance, or evidence company is exempt if there's a state waiver. Completed draw schedule form. Completed 24-month project details. We need to see what projects they've completed in the last 24 months. Completed W-9 form so that we can make sure that they get paid. And copy of the 5 most recent permits, certificate of occupancies for residential new builds. And we reserve the right to request additional financial documentation as needed. We cannot approve the builder without these documents. Now, once we have these documents and this package completed, the builder can get approved pretty quickly. I've seen a handful of builders get approved within, 3 to 5 business days, which is great. One of the reasons why I said that third-party company and those brokers sending their VA construction loans to those wholesale companies, those 2 wholesale companies that offer the program, one of the biggest delays happens during this process, which is the builder acceptance approval process. And the project also has to be accepted from those third-party management companies. And it's no bueno, it's just not a good process. So builder's going to put in their primary contact, DBAs if they have them, business address, email address, date established, if the company is incorporated or not, their contractor license number, list of individuals that own more than 25% of the company, and then they have to answer these questions. Have they declared bankruptcy in the last 10 years? Are any of the defendants or any of the principals currently a defendant in any lawsuit or legal liability or litigation? Do you, the company, or any of the principals have an outstanding judgment against them? These are important things that you guys need to know, because this can cause financial hardship for a builder, which can cause the builder to do things with the money that they shouldn't be doing, or to, go tits up in the middle of a project, which is not what you want to have happen. So these things are a CYA for you guys to make sure that the highest probability of, the builder's financial solvency during construction, so that your house gets completed in the time it's supposed to be completed and that they have a good reputation. So does your company have any experience completing ground up residential construction projects? What type of residential home construction does your company offer? Stick built, modular, manufactured? Manufactured homes must meet the Fannie Mae Manufactured Advantage of Freddie Mac Choice home requirements. Number of residential ground up construction projects completed year to date, and then it asks for the last 2 years. Number of residential ground up projects currently under construction, current average time, how long does it typically take them to build? Do they already have a builder line of credit? And if so, what's the amount? And then we get references from them so we can check their references. So that's kind of the gist of the builder approval process. It's not super overly complicated. Some builders have a hard time getting this package filled out and getting it back to us because they're builders. They're not office people and paperwork people. Some of them have staff that are office people and paperwork people. Some of them have spouses or family members or, whoever they work with. But this process can take a while. And that's one of the reasons why timeline is out of our control in a lot of ways, because we're waiting for the builder. We're waiting for the appraiser. We're waiting for the plans and specs. We're waiting for the contract. So one of the reasons why trying to figure out what the timeline is to close is kind of a little bit complicated. And we're going to talk about that. So different draw schedules. There's a line item budget draw schedule, a stage percentage completed schedule. I think the really important thing to know that you can articulate to your builder is we are flexible on the draw schedule, and we want to work with the builder to find a draw schedule that works best for them. So we will work with them on that. Doesn't mean that we're going to approve everything that we get presented with, but we will work with them, especially if they've done a lot of projects and they have a long history of successful builds. So, and usually those are going to be the builders that are a little bit more restrictive, are the ones that do more builds, and they're going to have a process that they want to follow, and a way that they do things. So this is just talking about some of the final draws and the interim draws and how that works. Okay, I'm gonna stop and answer questions. Make sure it looks like Mike is caught up on questions. We do have a list of builders in each state that we can provide. And there's also a list on the VA website, right? So you guys remember I told you that there is a VA website, or there's a way to look for an approved builder. I might not have said it actually, but the VA approved builders, you can do that by Googling VA approved builders near me. Now, make sure that you don't go to any of these other websites. Make sure you go to the .gov website, because I don't know the accuracy of any of this other information. I can only verify the accuracy of the builder website for the VA. So this is builder information. These are the documents I was telling you about that the builder has to complete. And then there's a list of VA registered builders on this website. So it's easy to find. If you don't know which builder you want yet, then you can go based on your city. If you're in Boise, Idaho, and you're wanting to build in Boise, Idaho, you can go search for less is more. So not putting in a name unless you actually know the name. Just putting the city and state will give you a long list of builders that have their VA approval number. So obviously this is overwhelming because there's so many that have their VA approval number. And a lot of these guys could just be contractors that were doing repairs on homes, but not building homes from the ground up. So when you're looking for builders that can help you with the VA one-time close, custom construction, and build for you, there's other ways also to be looking for builders. The things that I would be doing to look for builders, first and foremost, I would be Googling. I know that sounds like it shouldn't be the only option, and it's not the only option, but I would start there because I like the fact that I can go online and I can look at quality of builders, what type of homes are they building? What are they building? So if I wanted to, try and see if some of these guys have websites, now not all builders are going to have websites. And if they don't have a website, it doesn't mean that they're a bad builder, right? Some builders are just not great business, entrepreneurial type of people, but they're really good builders. So, and that's okay. But if I wanted to look for, let's say, Aspen Homes in Boise, Idaho, right? So you've got the list, they're VA approved, which again, VA approved doesn't mean anything. It just means that they've filled out the forms. So it's not like getting approved through the VA makes them that much better of a builder. So you can go and see, okay, Aspen Homes, building more than your dream home. This one looks like it's in Coeur d'Alene. So again, you have to figure out where is the builder located. But the nice thing is you can obviously go and you can see some of their floor plans. You can see some of the homes that they've built. This builder looks to be pretty high-end stuff, which is great if that's what you're looking for. So again, it depends on what your budget is. It depends on what style of construction you're looking for. Are you looking for a barn dominium builder? Are you looking for a builder that's building in neighborhoods? It looks like this one's also building in neighborhoods based on the photos and the lot. So when you're looking for builders, another place you can go is the local builders association. So like I'm in Okaloosa County, the Okaloosa County Builders Association. Did I spell today? Yeah, I got it right. A builders association. So there's a building industry association of Okaloosa and Walton County. So that's for our local county. And oftentimes they have the parade of homes on there, which is awesome because it can help you see some options for builders and what are they building. And then you can go out, you can actually walk through the homes and see what type of construction and do you like the construction quality and is this a builder that you'd want to work with? And then you can start talking to the builders about what options they have, what floor plans do they have. Some builders will already have floor plans that you can build with them and you don't have to go find a floor plan. You can also purchase floor plans online, and some areas will require that you have the floor plans modified or engineered to local building code. I can tell you my kind of learning lesson as we have been working on, I've owned a lot now. We've owned a lot now for 2 years. It's a waterfront lot. We're super excited to build on it at some point, but it's been a project. we've been working with an architect on plans, and I have been very busy with work, so I have not dedicated as much time and effort, absolutely haven't, as I could. But it is it's been 2 years I've been working with the architect, and I have spent more money than I ever should have in architectural fees. And I just learned just recently from one of my builders that in Florida, the architect owns the plan. So I'm upwards of $100,000 on a floor plan. And the architect actually owns the plans. I only get a one-time use of those plans. And I was like, you've got to be effing kidding me. But I wanted to build something really, perfect for the long-term home, the forever home, right? And so I went online, I looked at floor plans online, and I wasn't finding exactly what I wanted. Now, keep in mind, you can buy floor plans that you find online that you can modify. Okay, so that's usually going to be a more affordable way to get floor plans, is either find a builder that already has floor plans that you can build off of, or modify a plan that you buy online. That's going to cost you much less money than if you have an architect draft the plans from start to finish. Okay, I'm going to meet with my architect actually tomorrow. I have a call with her, and I'm going to try and convince her that I'm going to take those plans, because I'd like to be able to rebuild the house for profit if the floor plan is awesome and amazing. And I don't want her to own the plans. I want to own the plans. So I'm going to have that conversation tomorrow. I'll let you guys know how it goes. This is another form that has to be completed by the builder. So the builder has some work to do, and that's okay. These builders know when they're building houses, they have work to do. So this is the paperwork that is the description of materials for the VA, and this is for the appraiser, so that the appraiser knows how to appraise the property. That is one thing that happens once you've gotten pre-approved. And then the next step would be you start looking for land, and you start looking for a builder simultaneously. If you already own the land, then your next step, you skip to step 3, looking for a builder. If you don't already own the land, then you have to be figuring out reverse engineering your budget based on your total qualifying amount. When we pre-approve you, we're going to pre-approve you for your maximum ceiling limit, so that you can reverse engineer the project backwards from there. So you'll get approved for your ceiling limit, then you reverse engineer the project. The project costs are going to be, architectural, engineering fees. You might have to do land studies, permitting fees. You can get reimbursed for all of those things if you pay them up front. They just have to be included in the total cost to build. Once you have a floor plan picked out, you've got a builder picked out, you have a lot picked out, and you're under contract on the lot, and you're working with the builder on your plans and your specs. Your spec sheet is what is your foundation wall material? What is your interior foundation wall material? Chimney, what's your chimney material? What kind of fireplace? Is it solid fuel? Is it gas burning? Is it a circulator? All of these things go into determining the value of the home by the appraiser, because this is going to be how the appraiser adjusts the quality of construction based on the comparable sales that the appraiser is using to determine the value of the home. Future appraised value is what the appraiser is determining. So they're taking the land, they go out and they take pictures of the lot that you go under contract on or that you already own. And then they take the floor plans that the builder has provided, or the architect or the engineer, whoever provides them, and they're going to come up with a value of this home on this lot. But they need to have all of these details in order to know what kind of subflooring are you using, what kind of framing are you doing, 2x4, 2x6? Is it steel stud framing? Is it wood framing? What kind of roofing materials are you using? Is it a metal roof? Is it shingles or shake? All of those things play into how the appraiser establishes value. What kind of windows are you using? Windows type, the glass grade, is it hurricane grade windows? All of these things. So it does take some time, you guys, to walk through all of these things, and you have to have figured out. Don't let this overwhelm you, but you do have to figure out what you're going to be putting in the home, because that's how the value is established. And you have to build to that value. You have to build, the way the appraisal has been completed. Okay. You'll see that there's landscaping. You can include landscaping in the total cost to build. So all of these things go into description materials, how the appraiser is going to appraise the property. Okay. So that's a lot about the process, the last thing I want to show you, and then we can talk and answer questions. Well, actually, a couple more things. Plot plan. There is a requirement that we have a plot plan, which is the where the house sits on the lot, location of the home, location of the water well, location of septic. This is typically stuff that most counties require anyways. Most building authorities require a plot plan before you get your permits. So these are all things that you guys will be knocking out with the builder, and that's a good thing. Then let's see here. I am looking for, that's the builder resources. I'm sorry, I need to go out. I am actually looking for our purchase price estimator. So this is how we're going to come up with your loan amount and your purchase price. So like we said before, if you own land already, we will take that into consideration. And if you need equity in the land that you own already because you're trying to meet an entitlement requirement because you have another home, then we are going to have to give you equity for that property. So you have to own the home for a certain period of time. So let's just talk real quickly on guides on lot equity. If you've owned the home for more than 12 months from the note date, then the current value equals the current value of the lot. Okay, so if you own the home more than 12 months from the note date, we use the current value of the lot. If you've owned the home less than 12 months from the note date, we use the original purchase price of the lot. If the lot was gifted, so if a family member gave you the lot and there were no liens on the lot, we would use your current value of the lot. If the lot was gifted for less than 12 months from the note date and there is a lot lien, then we use the value limited to the lot lien amount and no equity is given. So there is ways to use equity. So if you've owned the lot already, a lot of people, a lot of veterans have purchased land, whether it be using, like in Texas, using the Texas Land Board VA loan, just the lot land or the lot loan. Or if you're doing owner carried contracts, you purchase land and you're just making payments to a seller, or you bought the land outright with cash. A lot of people will use their signing bonuses or re-signing bonuses to buy land. So yeah, if you own the land already, we can absolutely combine it into the total build package, and we can use the lot equity as a down payment towards your investment if you need, and it's not really money that you're putting down, it's just your equity that you're putting down to meet your entitlement requirement. We're going to talk about that so I can explain what that means. So how do we come up with your total purchase price? So first of all, we need to look at the estimated cost to build, right? So this is what the builder provides us with. All lot prep, well, septic, lot clearing, construction driveway, the builder soft cost, and all the costs from the builder. That is this estimated cost to build. So this is going to be your bid quote from the builder. So let's say that the builder is quoting you the cost to build of $375,000, okay? Then the next question is estimated value of the lot. If purchasing is part of the transaction, then we're going to enter the purchase price. So let's say you're going to buy a $50,000 lot as part of the purchase price. As part of the total package, you're going to write an offer on a lot. We're going to include the purchase price of that lot in this purchase price calculator. If you purchase as part of the transaction, we're going to enter in here the purchase price that you paid for that lot once again. Then we are looking at the 2% cost to build that is required, that 2% contingency fund, contingency reserve, and that's automatically going to calculate based off of our total cost to build. We're going to select our time frame on a $375,000 house. We're going to say it's going to take us 6 months to build, okay? So that's going to calculate our construction interim interest, which is right here, $13,737. This is, in theory, the money that you're saving by not making construction payments, mortgage payments on the construction loan during construction. If the builder finishes at 5 months and you don't have to pay that extra 30 days, then that money gets refunded towards your principal balance at the time of the modification. And on this money actually goes into an escrow account with us, the mortgage company, and that money gets transferred every month to pay your mortgage payments out of that escrow account to your mortgage. The builder doesn't actually have to make the payments. It just goes into an escrow account and it's paid by the builder, included in the total cost to build. interest reserve to be added to the builder's contract cost? Yes. So it's going to be added to this contract cost up here. So you're going to start with what the builder quotes you, but then you're going to add this into that. And you're going to end up with your total cost to build. Total estimated purchase price is $455,272. So when we're qualifying you, this is what you need to qualify for if you're going to pay $50,000 for the lot and you're not putting any money down and you're at $375 for the total cost to build. Now, something that we can also do is we can roll closing costs into this. So if the closing costs are going to cost, I'm just going to throw out a number right now, $10,000 for all the closing costs. That includes your taxes and your insurance and your any fees. We do not charge massive fees on these loans. We are very affordable. The fee breakdown is going to be based off of your construction amount. And so you can see on here for a $400,000 construction amount, for 6 months, the construction management fee, which includes the origination fees and everything else, is $8,535. So outside of that, your fees would be title, escrow, appraisal, taxes and insurance included in that, and some other fees that would be included, minimal fees. So typical closing costs that you would pay if you were building a house, okay? So again, this chart is kind of how we established, but it's not going to be an exact science. This is our estimated fees, and then we will dial in the fees and you will know what the fees are going to be. If you want to try and roll the closing costs into the total cost to build, you can do that as long as the appraisal supports that being included, okay? So this is kind of how we determine that. Now, let's say you own the lot already. Let's say you already bought the lot, you've owned the lot for over 12 months. Then how do we determine your loan amount? Well, if you don't owe anything on the lot, then you're not going to add anything here, and you're going to end up financing the $375 plus the contingency reserve, plus the estimated construction management fee, plus the estimated reserves for the construction, for the interest during construction. And that's your total amount financed, $403,398. If you owe money on the lot, let's say you previously purchased or gifted the lot, you review the lot equity guidelines. So if we owned it for more than 12 months, we would use the current value of the lot. So let's say I bought this lot for $75,000. And if the purchase, let's see, if lot is already owned but has a lien, into the loan payoff, the lot payoff. So let's say I owe $30,000 on the lot. I'm going to put that $30,000 here. And that's where my potential lot equity is $45,000 that I could use towards my VA loan entitlement. If I have another loan outstanding and I need to make up a VA loan entitlement down payment to finance the total amount of my purchase price. Okay. I can show you a little bit more of what that looks like. But let's just wait a minute. I'll get to that in a few minutes. Okay. So that is the calculator that we use to establish your estimated loan amount when you are financing and using the construction loan to buy land and build, or you're paying off any loan that you already have on the land that you already own, and we're combining that into your total cost to build, your total purchase price. We're going to call it purchase price, even if you already own your land. Okay, I'm going to stop and answer any questions that we might have on the estimated cost. Let's see here. I'm going to scroll down. Paul, thank you for coming to the class. He had to go. Actually, that was a while ago, so he's already gone. Thanks for the info, Greg. You're welcome. We appreciate you guys coming. I know it's a little bit longer. There is more information that we can share, but that's a lot of information about the VA one-time close. I think the last thing that we need to just cover real quickly is if you already have a VA loan, what are your options? So let me go through those options. If you already have a VA loan and you want to buy land and build, so you have a couple different options. Option number one is you get to keep the home that you have, live in it while you're building, but you have to qualify for both the new home build and you have to qualify for, yes, Dominique, I'm going to put our website in here. So you have to qualify for the new home build and you have to qualify for the existing home that you own, okay? If you are going to, and the reason for that is because we're closing before the construction starts. So you have to qualify for this, even though you're going to probably put the house on the market and sell it or turn it into a rental and we could use rental income to offset the mortgage. You are, at the time of construction starting, you're still going to be living in the home. So you still have a housing payment. Now, if you're renting, we do not have to count your rent in your debt to income ratio. This is only if you own another home. So some solutions. If you plan on keeping that home long-term and turning it into a rental property, one of the solutions that you could leverage is you could move out of that home, turn it into a rental property right away, and qualify. Actually, what you would do is you would close on your construction loan, but you would be turning it into a rental property. We'd be treating it as a departure residence. When you treat it as a departure residence, we use the lease amount. You don't have to have an actual written lease, but we're going to use what we find online. There's a couple websites that we go to, and we look at what the fair market rent income is for your property. And we are going to be able to use that as income to offset the mortgage payment on a departure residence, but you have to be moving out of the property and turning it into a rental and living somewhere temporarily while you build your home. So you can live in RV on site, a travel trailer, a pop-up trailer, a tent, a yurt, like whatever you want to, you could live on site. And then you could move into a rental and live in a rental temporarily while you're building your home. You could live with family temporarily while you're building your home and not have to qualify for both housing payments. If you qualify for both housing payments, obviously that's easy. You can, just qualify that way and do whatever it is that you want with your home. You can wait to sell your house until after your new home is built, and then move out of your old home into your new home and then put your home on the market. That's what most people would prefer, but you have to be able to qualify for both mortgages if you're going to do that. I have 2 homes on my VA loan. Can I use the rent from the one while construction without having to move out of my home? So Carrie, no, you really can't, because the VA doesn't allow you to go off of future rents when you're actually trying to qualify prior to closing on the construction loan, which is prior to construction starting. So what I was just saying are your 2 options. You can either move out of it, turn it into a rental, and move into something temporarily, which I know is not the favorite solution, but you guys, if you're building your dream home, it's a short-term loss for a long-term gain. So you could live in an RV, you could live in, some sort of, we lived in an RV actually for 3 months while we were waiting for a house to be, to close and then to be remodeled. It was a probate kind of deal, and so it took longer to close, and then we had some work we had to do on it. So we actually lived in an RV with 3 kids and 2 dogs, or maybe 1 dog, maybe just 1 dog at that point. But anyways, we did that for 3 months. So there are a lot of options there. And unfortunately, you do have to qualify for this at the time of closing on the construction loan before the construction's even started. How long do you have to live in the home before you refinance? Let's say I own my own home and live in it during construction, then I move into my new home and sell the old home. I would want to use the money from the old home to pay down the construction loan. Yes, you could do that, James. When you say before you refi, in my mind, from what you just said, you're not refinancing the house that you currently own. You're just going to keep it, live in it during construction, move into the new home, and sell your other home. So you're not selling the home that you were living in during construction. The refinance question, I think, comes into play with how much money you'd be putting down wanting to re-amortize your mortgage. And that's actually a good question. Let's say, James, you're going to make $200,000 from the sale of your home, and you want to put that money towards your permanent loan. But if you don't sell your house prior to your construction loan closing, you can't do that. So if you take that $200,000 after your construction is completed, I don't know if we can actually do a reamortization at the time of modification. That's another question I'm going to ask. The reason I'm asking, there's a term, it's reamortization, and basically what that means is you're paying a large chunk towards the principal balance. So let's say you get $200,000 from the sale of a property. You want to apply that towards your new mortgage, but you want them to actually re-amortize your mortgage payments so that your mortgage payments go down based off of the new lower balance. You can't typically do that on a government loan. The VA loans do not allow you to recast is what it's called, recast the mortgage. A conventional loan sometimes allows you to recast depending on the lender, but a VA loan does not. So you would either have to refinance it or it could possibly be done in the modification. So I'm going to have to follow up. And then we have the email addresses for all of you guys that have attended tonight on Zoom. TikTok, I do not have your email address. So if you're looking for that information, I need you guys to send us a DM from TikTok and let us know that you're looking for the answers to these questions that we talked about during the live. But yeah, we will find out if there is a way when they're doing the modification of the note after the construction is 100% complete. If you've sold your house before they're modifying that note to the permanent loan, is there a way to do a recast and a pay down of the principal balance? So I'm finding that out and we're going to get back to you. If we're a few years from settling, but we're trying to get a head start on our forever home and it will be our only home and permanent residence, would we qualify? Kathy, so I mean, you can definitely apply now, but is your pre-approval going to last for 1 to 2 years? No, your pre-approval is only going to last for the period of time, like right up to when we close on it. So a better way for you, there's some people that if you're looking at Texas, like if you're interested in buying in Texas and building long-term in Texas, but you don't want to build right away, you can still buy land in Texas using the Texas VA loan. It's the only state that has a VA land loan that you can buy land on and just make payments without having a balloon payment due in 1 to 2 years. Most land loans require a balloon payment in 1 to 2 years. So that's why that's not typically ideal. You do have the ability to potentially find a lot that the seller is selling as a owner carried contract, where you could potentially buy the land then, but you definitely want to make sure you qualify. We could run a pre-approval and just tell you how much you qualify for, Kathy, so that long term, that this is your budget. And if nothing changes in your income and nothing changes on your credit and interest rates stay roughly the same and property taxes stay roughly the same, then you would know, and homeowners insurance, then you would know your approximate qualifying amount. So if you're a few years from settling, you're trying to get a head start on your forever home, and it will be your only residence and permanent residence. The other thing is, if you're active duty and you're transitioning out, or you're active duty, your spouse can satisfy occupancy for you. So you could build the house while you're still active, stationed somewhere else, and your spouse is actually satisfying occupancy. And again, because you don't have construction payments during construction, you can get started on construction 12 months out from moving into your home. And you're going to want to do it before you're 12 months out from ETSing, because if your ETF date comes up within 12 months of closing, we have to use other income for qualifying. So like retirement income we could use, but we won't be able to use permanent job income unless you have an offer from an employer and you're closer to that 12-month period or less than 12 months. So there's a lot of different things there that come into play. There's a lot of unique things and unique scenarios. And that's why sometimes these one-time close take a lot of conversation to figure out all the moving pieces. So if you're saying if we want to build and we found land right now, I just want to make sure that we can do that without moving it into it right away. You actually have to occupy the house if you're going to build it. You don't want a house sitting vacant. So you would want to be able to, you can't use the custom construction loan to buy land and sit on the land. You're required to start construction within 60 days of closing. And then you're required to move in once the construction is completed within 60 days or a reasonable period of time. But you just don't want a brand new home sitting vacant when you're not in that part of the country, or you're not in that part of the state or city or whatever. It's just not a good idea. That's when you have loss of, people squatting, leaks, things happen, you don't want your brand new home to be damaged. So I would say the better option is to look at building prior to moving, but time it to where you're going to move in shortly after your construction is completed. If the appraisal is higher than when it started, how long before you can do a cash out refi? Good question, JP. So you cannot do a refinance until 210 days. This is the VA requirement. You cannot do a refinance until 210 days from your first payment due date on your permanent loan. So your house has to be fully constructed. You have to get 210 days into your new mortgage, after they modify the mortgage into your permanent VA loan, then 210 days from your first payment due date, then you can refinance. So you're going to end up doing a modification, but if you're trying to do a cash out, full cash back out, you're going to have to wait 210 days from the first payment due date of the modified mortgage. Let's see here. I think I have 2 homes on my VA loan. Yep. Okay, we answered that one. That's going to be a lot of people's scenario. And honestly, you guys, you might just have to bite the bullet and move into temporary housing while you're building. You'll save money anyways. I know it's not people's favorite option. It's not fun to move twice. I get it. Totally understand it. But if it's your only way of making this work and it's really what you want to do, then that's what we end up advising clients to do. Mike is addressing the anonymous attendee that is asking, do I need 12 months of rent before I build a fourplex? So he's going to answer that question. But I guess I can answer it verbally as well. The question is, do I need 12 months of rent before I build a fourplex? No, not with this particular program, because on this program, you're not using rental income to offset the mortgage. So because you're not using rental income, you don't need to have a history of being a landlord. You're not using rental income. The only time that you need a history of being a landlord is if you're trying to use the rental income from the other units to help you qualify. You also shouldn't need reserves, because reserve requirement comes into play on multifamily when you're using the income to qualify. Did you touch on how much the whole process for building will be? I might have missed it. My screen froze. We did talk about the fees. You're going to have regular closing costs, right? Regular closing costs are associated with the VA one-time close. So appraisal, title, escrow, homeowner's insurance, property taxes. If there's intangible taxes for the state, anything that's state specific, survey, you might need a title survey. Those kinds of things will all be required as regular closing costs. And then on top of that, the only other fee is going to be the estimated construction management fee, which includes the surveys or the inspections during the draw period. Your interest reserve, which is rolled into the loan amount, and the construction management fee is rolled into the loan amount and finance. So those fees are financed. So really you just end up with typical closing costs that you need to either finance into the total build package if the appraisal supports it. If your appraisal comes in high enough, you can have the builder pay $10,000 towards the closing costs and really not have to pay closing costs at closing on these construction loans. I would be prepared to pay for, you have to pay for your earnest money deposit on the lot. And real estate agents are going to be the ones to tell you how much that earnest money deposit is on land. I would be prepared to pay for maybe some permitting or some land studies up front while you're buying your land. So let's talk about this really quickly. If you're going to be buying land with this program, we need to make sure that you give us a reasonable period of time to close on the construction loan, because you guys have seen we have to get the builder approved, you have to get the plans and the specs, you have to have the appraisal done. So we need a 60-day timeline from the time that you write an offer to the time that we close. We can often get it done in less than that. We have one right now that will probably end up closing in 40 days, but they already had the plans. The builder was really quick and very responsive. He filled out the paperwork, got it right back to us, had the plans and the specs and all that stuff done. So we were able to order the appraisal pretty quickly. And again, we're ordering the appraisal directly from the VA, and it goes directly to a VA appraiser. So we don't have a whole lot of control over the turn times from the appraiser. But there are structured turn times for a VA appraiser on all VA appraisals. I would just say that they're a little bit slower on the custom construction. So when you're making an offer on land, you may need to do some studies on that land to make sure you can build what you want to build. And it's called a feasibility study or a due diligence period. So usually how most realtors are writing the contract is you're writing for a 60-day closing from the land purchase for the time you get under contract to closing. But in the first 30 days, you're doing a feasibility study or a due diligence study to make sure that you can build what you want to build on the land that you have gotten under contract. Sometimes you run into a situation where there's literally like bedrock or a slate under the ground and you can't dig into it to build a foundation, or You can't get a septic approved because it won't drain properly. The type of clay, the type of soil that's there. I mean, there are solutions for most things, but every once in a while you find a situation where you can't build what you want to build on the lot that you get under contract on. And to protect your earnest money deposits so you don't lose your money, that is why that feasibility period or that due diligence period exists, is to make sure that you don't lose that money. So there's a lot of details on that, and there's a lot of information as you get closer to that part of the process. We will talk through with you and make sure you guys have all of the information. And again, another reason why it's very important to make sure you're working with a real estate agent who understands land transactions and has done land transactions and also understands how to work with VA buyers and has worked with VA buyers before. We will help you guys with that. We will be a big part of the process and the conversations, and we can help you have the conversations with the builder. We can get involved in that. And when we pre-approve you, we're going to pre-approve you for a new home build. We're also going to pre-approve you for an existing build, because oftentimes what we find is somebody, you know, in your mind, you have this idea of this house that you want to build, and you have this idea of this budget. And when you finally dig in and you get into the process, you realize I can't build what I want to build for the cost that I thought I could build it for. And then you end up finding a house that's already built, or a house that's on acreage, or a builder building a house, and you end up just buying something that's already completed. Now, not everybody does. I think we have 7 or 8 of these VA one-time close custom construction loans going on right now. Our highest price one is 1.8 million, and or 1. Actually, it's 1.9 total acquisition. And that one's going to close successfully. And, you know, it's a great deal for that buyer because she was going to use conventional financing and have to put 20% down. So she's saving a ton of money using her VA construction loan, and her interest rate is better. So, okay, any other questions on the VA one-time close? I'm going to put our website here again. If you're on TikTok, you can click on the link in my bio. It'll take you to some options to connect. You can also DM us and we can get back in contact with you to answer your questions. If anybody here didn't get their questions answered, if we missed some of your questions, go ahead and send us an email or give us a call, DM us, however you need to get a hold of us. You can shoot me a text. It's going to be better than a phone call because I'm in meetings all day, every day. So I will be able to text you back and get my team connected with you. Same with Mike. I'm going to put Mike's information in here. He's been in here answering questions. Thank you so much, Mike. I appreciate you answering all those questions. But go ahead and text us. And our email address is VALoanbish@VLGteam.com. So you can email us your questions there, and we can make sure that one of our loan officers, if not us, gets back in contact with you to answer your questions. So we appreciate you guys being here tonight. We do have a recording of this, and I will go through and make sure that we've got all the information there, but we will get that over to you guys so you can have it. If you're interested in it, send us an email. And then we'll follow up with these few questions that we had as follow-up questions and send that out to you guys in an email so you've got that information. So we look forward to assisting you in however we can. Again, we do lend in all 50 states. This custom construction program is available in 49 states. Alaska is the only state that is not available in, but we do lend regular loans in Alaska. So if you guys need anything else, reach out to us. Thank you so much for attending tonight. We appreciate you guys, and hope that you learned everything that you needed to determine whether or not you want to buy land and build using your VA loan. So thanks again. Have a good evening, everyone.